Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started.
Welcome back to another episode of Alternative Investments Chat. So when people say that they are, quote, investing in the stock market, what they're usually talking about is common shares. It's possibly the form of investing that you hear about the most, right?
Yep.
But I think a lot of people take that for granted.
Yeah.
I don't know about you, but before I was investing, I was always a little shy to ask questions about investing in the stock market because it seemed like I was the only person who didn't know.
Right.
And I didn't have all the info, and I didn't want to embarrass myself by revealing that I was the only one that was out of the loop.
Well, you already did embarrass yourself by letting our listeners know that you didn't have a high yield savings account.
That's true.
That we did get you one.
Yeah, that's true. Well, I had one before.
Yeah.
I admitted that. Let's be clear. But now I know that there are plenty of people like me who were just as confused. So, after all, they don't teach how to invest in stocks in school. So we all have to learn somewhere, somehow.
You're right. They don't teach a lot of actual practical stuff in school, but again, we won't get down that rabbit hole. I'm still using Pythagorean's theorem every single day, however, just in case any of my math teachers were wondering. But our listeners, probably have the same questions about investing in stocks that you have. And they're probably just as nervous to ask about them as well, because at one point you're never alone. Okay. We have to start somewhere, and not knowing is where we all start,
yes,
right?
Exactly.
So it turns out that not just watching a ticker go up and down, that's not what the stock market is.
Yeah.
We talk about the stock market game, how I used to play with my grandfather. I thought that's what investing in stocks were. So for this episode, we're going to dive into what common shares are, how they work, and everything that you're going to need to know. Even if you're brand new to investing and don't have a high yield savings account. If you don't, tune into that episode, please, so that we can get you one.
Exactly. Well, as usual, let's kick things off from the top here. So what are common shares? First, let's remind ourselves about equity. That's the thing that people on Shark Tank exchange for money when they go on to pitch their idea. The same principle applies here for common shares or common stock, but you get to play the role of the shark.
I like that.
You get to give your money to purchase shares, which gives you a piece of ownership in the company that is issuing the shares.
Okay.
The more shares that you own, the more ownership that you have.
Wow. So basically you're saying that if I bought some Amazon shares, which I think I have some, I'm basically Jeff Bezos?
In a way, I guess,
Okay.
if we're being generous with you being like Jeff Bezos. It's true. You would be just like him in the fact that you both are Amazon shareholders.
Yes.
But don't expect to be going to fund your own space program anytime soon.
Dang it.
Yeah, dang it.
I'll have to scratch all that. Okay,
Well,
that's what I spend my afternoons doing.
Well-
You saw my notebook, didn't you? That's how you know.
Well, let's get some perspective on this. As of late of 2025, there is approximately 10.4 to 10.5 billion shares of Amazon around.
Okay.
So if you bought one share, which is currently hovering at about $208 at the time of us recording this episode, you would own 0.0000000095 of Amazon, 95% of Amazon. So that's 10 decimal places.
Okay, so that's probably about what I own.
And Jeff Bezos is the largest shareholder with about 8% stake in the company. So you might be thinking,
That's not a lot.
yeah, that doesn't seem like a lot for the guy who started the whole thing, 8%. That seems pretty small. But that equals 882 million shares.
Okay, so that makes a little bit more sense. So really what you're saying is that I can own as much stock in Amazon as Jeff Bezos if I just cough up, I don't know, let's say 183.5 billion.
Billion with a B, dollars.
Let me, do you take Venmo?
Yeah, exactly.
My phone's over there, but I will get this thing going, Anyway, but just all that joking aside, how do you even start investing in the stock market? We've talked about this. How do you get your money from point A to point B? These are such basic questions. But because they're so basic, I feel like no one ever wants to talk about it or
Mhm.
ask those questions. Like you
Yep.
said, you're embarrassed.
Yeah.
So we'll have no fear. Don't even worry, guys. We're going to walk you through it all together. So first up, you're going to open up a brokerage account,
Yep.
which I always highly suggest doing. I have one myself. And of course, you're going to hear some of the most popular financial forums or platforms do this. So we've got Charles Schwab, Fidelity, Robinhood, E-Trade, all those I'm sure you've seen
Yeah.
commercials for, heard their names of some sort.
Right.
So you're going to actually do this online in your pajamas at your
Yeah.
house if you'd like. Follow those steps to get it set up and either transfer funds from your bank account to your brokerage account, or you can actually link them.
Mhm.
A lot of them do prefer that you link them, and that
Mhm.
way you can just automatically pull funds. Now, please remember that there are limits on that too. Read all the fine print. We
Right.
always expect, want you to do that. But done. First
Mhm.
step, boom, bang, bang.
Yep.
Got it. Okay. Then here's the actual fun part. You get to explore the stocks in the brokerage app or site.
Mhm.
So every publicly traded company has a ticker symbol, like the ones that run on the bottom. So for Amazon, for example, it's AMZN.
Mhm.
Apple is AAPL.
Mhm.
Apple. No, sometimes the tickers don't make sense in my brain, but that's what they get, right?
Mhm.
So here you can see what the current stock price is and how much if you want to decide to buy it. When you buy, you're actually purchasing common shares by default unless explicitly stated otherwise. So when we say explicitly stated otherwise, like for example, I invested in through a crowdfunding platform, which is completely different than a public share, but I
Mhm.
have stock with no voting rights, which
Mhm.
we will get into in just a little bit.
Yep.
But I just want to make sure you're reading the fine print when you
Right.
are investing. Stock market's a little bit easier though. So once you decided what you want, you're going to go ahead and make that trade. So you'll choose how many shares or dollars, if you're doing ETFs, you want to actually invest. And then, boom, you buy them.
Yep.
Just like you'd buy new shoes on the internet. And just like that, you're now the brand new owner of some fabulous heels and hopefully some stocks as well.
Yeah, exactly. So the internet does make things a lot easier.
Heck
Thank you.
yes.
Thank you, internet, for that.
Yeah.
But after the trade, your shares are going to pop up inside of your brokerage account and they're going to live there unless you get rid of them.
Mhm.
In the past, you would get like a fancy paper certificate, but now everything is digital. So no certificates for you,
Ah,
which is a little bit of a bummer.
yeah.
One of our coworkers actually collects old stock exchange certificates. It's pretty
Yes.
cool. He brought in a book. So
It was
I kind of feel like bring that back.
It was cool.
But
I know. We should have asked to borrow some of those so that if you're
Yeah.
watching this on YouTube, we could have shown you some because they're really, really cool.
they're really cool.
It's
Lots of detail and
uh-huh.
very beautiful. But now everything just lives inside your phone, which is, I guess, cool in a different way.
Yeah.
But now that you've got your shares living inside of your brokerage account, what does that mean for you as the investor? One of the things that comes with being a part owner most of the time is voting rights, like
Mhm.
you mentioned. You can weigh in on important decisions like electing a board of directors or approving other major decisions that
Yeah.
come through. Typically, you get one vote per share that you own. And another thing that you might get is dividends, but I'm actually going to put a pin in that because we have another episode coming up where we're going to talk all about dividends, dividend-paying stocks. So we'll just put that one to bed for now.
Pause. Yeah. Don't spoil all those secrets there. Spoiler alert, right? So when it comes to making money off of your stocks, aside from racking in those dividends, again, that we'll talk about in a different episode, you're just looking for the appreciation. So just like real estate, you want to see the market value for your stocks climb, meaning that your investment will increase.
Yes.
That's always the fun part for me to watch so that you can hopefully sell these shares when the time comes, the more than what you paid for them. Again,
right.
we're going to buy low, sell high.
That's the dream.
I love watching, like when I look on my brokerage account and I see that it's gone up. And so then I see what my trade value is. And I'm like, dang, I've already made this much money on this one. I'm like, okay, this is
Feels
kind
pretty
of
good.
fun. Now when they're down, that's a whole different thing. But so why do companies actually issue stocks in the first place? What is the point of it?
Mhm.
So issuing stocks is all about raising money. So a lot of companies find that they can only raise so much capital through borrowing it from friends and family, crowdfunding, venture capital, which, we've talked about on many episodes. So issuing stocks can actually be a great way to raise large amounts of capital to do many, many things. Expand into new markets, build factories, develop technology, and everything else a business needs to carve out a decent chunk of that market
Yeah.
again. So unlike a loan, however, stock issuers don't need to make interest payments and they don't have like a payback schedule. So you go on to the exchange and you put your money and it goes to the company. So this form of capital is pretty flexible. So it just goes to the company, which is kind of awesome.
Yeah. So here's a fun fact. Did you know that the first company to ever actually issue the first stock was the Dutch East India Co. all the way back in 1602?
1602.
Pretty
Well,
crazy.
we did an episode on the history of stocks. These are not brand new things.
Yeah, but before you ask, listeners, yes, that Dutch East India Co. that we all learned about in our high school history classes, the one that held a 21-year monopoly and had the power to wage war, govern colonies, maintain armies, they engaged in slave labor. I mean, crazy. Could you imagine if Apple had the power to do that now? I think knowing some of this history makes it make more sense of how our founding fathers set up America's government. No corporation, not Apple can't say tomorrow, we're going to war. So thank you for that.
They just go to war with Microsoft, right? They just within their own industry.
Right, but they can't deploy our American army on their behest. So we are happy for that. But still, the Dutch East India Co. holds the title of being the world's first IPO, which is pretty cool.
And hopefully our listeners, when you heard that, didn't think of Dutch Bros. They are not the same thing, okay? But I'm really glad that you brought that up because I think we should probably touch on what IPO actually is. So IPO stands for Initial Public Offering. When a company says they've gone public, that means they've officially secured their IPO ticker and it is out to the market, right? It just means that now shares of that company are being publicly traded on the stock market. So when it came to the Dutch East India Co., because now I want to say Dutch Brothers, they went public because global trade back in the 1600s was super expensive and dangerous. So traveling on long voyages to Asia left ships very vulnerable to shipwrecks, piracy, and disease.
Real life pirates.
Real life pirates, like the one in that movie. I am the captain now. Anyway, so issuing stocks helped the company spread risk amongst themselves and investors and even amongst the fleet of the ships. Because again, if one ship goes down, everyone
whoever invested in that one
everyone
ship
lost a little
everything.
bit instead of just one. Everyone loses a little bit instead of just like one person being like, well, crap, there goes my whole ship. Now what am I supposed to do with it?
Exactly. A little bit of risk seems a lot better than a whole lot of it.
You're right.
That seems a little bit scary. And another reason why companies go public is to give the option of liquidity to early investors. People who get in early can cash out their shares if they want to. They can cash out a portion of their shares and they can reap the benefit of the investment that they made long ago before the public was even able to get in the door and get involved with this company.
Like the crowdfunding one I did. I'm waiting for them to go public then maybe I can get some money off of them.
Exactly. See? And not to mention a successful IPO can create some really great buzz for a company to increase their brand recognition, to expand into new markets, and to generate higher profits. They get a lot of buzz going about this. Lots of people want to maybe purchase their product, want to utilize their services. That's more money into the investors' pockets.
I like that, especially as an investor. So, well, we know that stocks have a great potential to generate amazing returns. There is a reason why stocks remain the foundation in most financial portfolios. I remember when we first went down this journey, it was 60-40, and that's because you won 60% in the stock market, which was crazy. But of course, there are still things to consider before jumping headfirst into the stock market. Before buying those common shares, again, due diligence matters. I know you might not think this because they're publicly traded. How could they ever deceive me in any shape, way, or form? Trust me, it happens. So investors should look at a company's fundamentals, there we go, revenue growth, profitability, debt levels, and cash flow. Just because they're a public traded company doesn't mean they can't go under, right? You also want to understand valuation. A great company can still be a bad investment if the stock prices already reflects unrealistic expectations. Again, Amazon has a $208 per share because it is shown to be worth $208. If you showed me another company that is brand new and their shares are trading at $208, I'm going to be like, skeptical. I might just skip that one or put it on my watch list.
Yeah, sure. Exactly. And another consideration is dilution risk. Companies can issue more shares, which reduces existing shareholders' ownership percentage. Let's think about Amazon having 10.4 to 10.5 billion
Yeah, I
shares.
know, right? That's a lot. Oh, it's a lot of shares.
Yes, for the people who got in the door with Amazon when it first started, how many shares were then? Maybe a few hundred, I don't know,
Yeah.
1,000, whatever. But it climbs up, and all of a sudden,
Yeah.
we got a lot more.
Yep.
So that means that your stake decreases as more shares are issued. And finally, also, time horizon matters, as it always does. Common shares historically reward long-term investors far more than short-term traders.
Yes.
Over time, staying patient. Now, let's talk specifically about the pros and cons of common shares, and let's start with the pros. High growth potential is one. There is no cap on the upside. Essentially, stock prices can theoretically grow indefinitely. No one is going to, come and say, that's too high.
Yeah.
Which is pretty nice if
Yes.
if you hold stock in a company that's doing really, really well.
Yes.
And as the company grows, its profits and value grow too, and your wallet can see the direct outcomes of that. Also, aligned incentives. When you purchase stock in a company, it's kind of like joining a team. All of the owners, including you, have an aligned interest to see the company succeed.
Yeah.
And investors can let their voice be heard through their vote, and ultimately all want what's best for the company because they want their money to do well, their investment to do well.
Yeah.
And something else to note here, a lot of public companies give their hires, especially like managerial or executive people, stock options as an incentive. So the employee's take-home pay is directly influenced and tied to how well the company's stock is doing. And this means that there's a little bit more incentive for them to do everything that they can to see the company succeed. Definitely a little bit more than someone who works at drive-through,
Yeah.
who is working like a, part-time job. Like they're just there to do their work, earn their pay, and go home.
Clock in, clock out, and get my paycheck.
They don't really care about making sure that McDonald's becomes the #1 fast food company that year. They're there to do their work and move on. But if you give them an incentive that is directly tied to that outcome, sometimes you'll see that people will care a little bit more about that. And then another thing to consider also, liquidity.
Yes.
Stocks are easy to buy on public exchanges, and your money isn't tied up for years at a time. With a lot of these like private placement investments that we talk about, your money is potentially locked up for a couple of years.
Yeah.
And you won't see that until the end of that investment. So this is pretty cool. If you need it back or you're like, I'm out, you can do that at any time. And also, all prices are transparent, so you know what's going on with your investment at any time, which can offer some peace of mind.
Yeah, and there's on-market and off-market times, which I love. And I know I've mentioned this many, many times. I look at and check my stocks a lot. To me, it's fun, and it helps me feel good that I know what I can see. I can like literally look at my phone and see what's going on whenever I want. I mean, I check it in the morning. Sometimes I forget because, again, I'm not going to move it. I'm just curious of how it's going. Again, I got into NVIDIA when it was a little bit newer. And so I love looking that's probably the one I have the most money return as of right now, but I'm not touching it. I'm just letting it sit there because I know it's going to go up. But it's nice to be able to pull it up at any time and be like, I wonder what's going on.
Right.
So obviously when you invest in a private placement, there's a lot more things going on behind the scenes. There's not really apps. Same thing. Like I just mentioned, I do have that crowdfunding investment. I can't see what's going on.
Right.
And I've only had my money. I'm assuming I'm going to have a lockup period of about 5 years before I see anything. We're going on about year 2, but I'm not worried.
Yeah.
So I just let it be. But sometimes I wish I could log on and see what was going on. Truthfully.
Yes.
So something else to consider with this, though, is the limited liability. So investors can't lose more than they invest. So it's kind of like a way, like gambling. Like when you go and you put $100 in that slot machine, when the $100 is gone, you're done.
Yeah.
Right? The machine can't be like, actually, you now owe an extra $5.
Yeah, exactly.
Because you hit the little thing again and now you win. Okay.
Right.
So because of this, you can actually budget your investments in the stock market and only put in what you feel comfortable
Right.
potentially losing if you are one of those super risk adverse people.
Yeah,
And
exactly.
again, I like that as well because like I can see how much I've made, but I know that I'm not going to lose any more than I put in. So
Exactly.
it's kind of this safe feeling.
Mhm.
So, but speaking of those risks, I know that, we have to talk about them. So let's go ahead and why don't you kick off those risks for
Sounds
us?
good. The risks will come for us all eventually.
Yes, I know.
But the first one is pretty obvious, and that's price volatility. Prices can fluctuate a lot. We just covered the '08 financial crisis, and this is a great example of when things go horribly wrong, seemingly out of nowhere.
Yeah.
Investors saw the stock market flip like overnight, and the losses were major for those investors. And there's several other examples of the market fluctuating wildly, like as major as the Great Depression and as minor as like a little dip
Mhm.
that makes everyone panic. So that's definitely something to consider. And something that you might not know, common shareholders are the last in line to get paid if the company ends up going under.
Yeah.
That's right.
Uh-huh.
Common shareholders only get paid after all debts and preferred stockholders are paid, or preferred shareholders are paid. You'll hear those interchangeably, which means that the money that you put in, it might not even make its way back to
Right,
you.
right.
If they're going down the line and you're last in line, oops, we ran
Oops.
out.
Yep.
Just like all investments, there are no guarantees, but especially with stocks, there's no real recourse to like recoup your money.
Yeah.
It's basically the equivalent of like a slot machine eating your money. Although you have a little bit more than just chance,
Yeah.
but it's like you put in your $100, it's gone, it's gone.
And you didn't even get to hit that spin
yeah,
button.
you can't get it back.
And then what are you going to do? They're not going to give it back to you.
Yeah, I
So-
want my money back.
Yeah, they're like, no, I
Yeah,
don't.
you
no,
played the
that's-
game.
That's not how it works. So, something else that also gets overlooked in the risks here, but investing is emotional.
Mhm.
Okay, so it's very easy to fall victim to your own emotions, especially when you have full access to see your investment and what it's doing at all times.
Yeah.
Kind of like it reminds me of the meme stock, or what was it? There was
GameStop?
GameStop.
Yeah.
Thank you. I'm like, there's like 3 different documentaries on it. People were panic buying, selling, jumping on the bandwagon.
Yep.
And then you also have that existential dread that, has its side effects as well,
Mhm.
like letting your emotions get the best of you. Those people definitely did. They
Mhm.
saw this thing happening and they had that FOMO and were like, I have to get on. And guess what? Most of them lost a lot of money.
Yeah.
There's like one guy who made like $1 billion. And I'm like, good for you, bro. Cause
Yeah.
you saw it hit its high and then you bounced.
Yeah.
And then everyone else, I mean, they were putting a lot of their savings into it and that sucks. But
Yeah.
remember, again, you need to do your research and remember the old, what is it like? Haste makes waste.
Yeah.
So
exactly.
we just remember, okay. And to prevent yourself from losing any sleep or spiraling into depression from the complete loss, some of these people really did.
Mhm.
Again, don't ever leverage yourself. Invest comfortably. And I know people say you have to spend money to make money, but at what cost?
Yeah.
Do you really want to spend all your money to potentially lose it?
Right. Exactly.
Don't fall into that.
Yeah, do
that
what
trap,
makes sense.
okay?
Exactly. Well, in conclusion of today's episode, I think that we can see that common shares are simple in concept, but can be really powerful in execution, both powerful good and powerful bad.
Yeah.
This investment is really about one simple trade-off. You get partial ownership with potentially high returns, but no guarantees.
Mhm.
And when a company you invest in succeeds, you get to see the growth in your portfolio.
Mhm.
But you also accept the risk that things can go wrong, and that money might not come back to you in the worst case scenario.
Yeah, you're exactly right. And turns out that the foundation of the stock market we see today was laid way back in 1602. It's a system of risks and sometimes flaws, but it has endured, and generations of investors have keep coming in, and companies keep going public.
Yep.
And there's lots of other twists and turns. So ultimately, common shares are allowing these companies to distribute risk and raise capital to grow. And the creation of this type of capital risk made it possible for some of the greatest inventions and products to become a reality.
Yep.
So
That's
don't
exactly
forget
right.
that.
Well, just remember, this is a long game and not a shortcut. But that is it for today's episode. We hope that this conversation made understanding stocks a little bit easier. And if it did, leave us a comment and maybe share it with a friend. And we will catch you on the next episode. Bye.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the alternative investments chat.
See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.